Hey everyone, welcome back to the channel. In today's video, we're diving into the regulations section of the CPA exam. This part of the exam is all about federal taxation, ethics, professional responsibilities, and business law. We're going to walk through 10 multiple-choice practice questions together, breaking down not just the right answers, but also the traps the examiners love to throw in. By the end, you'll hopefully have a clearer picture of how to approach regulation questions under exam pressure. Let's get right into it.
Question. Alexandra, a CPA, is preparing a tax return for her client who wants to claim a deduction for a business expense that has a 25% likelihood of being upheld if challenged by the IRS. Alexandra is aware that there is no substantial authority supporting the deduction, but she believes that a reasonable basis exists. The client insists on taking the deduction without any disclosure. According to Circular 230, Section 10.34, what should Alexandra advise her client regarding the deduction? The options are: Option 1. Alexandra should advise her client that the deduction is unreasonable because it is not the prevailing view among tax professionals. Option 2. Alexandra should advise her client to disclose the position to avoid penalties, as the deduction has a reasonable basis but lacks substantial authority. Option 3. Alexandra should advise her client that the deduction can be claimed without disclosure, as it meets the reasonable basis standard. Option 4. Alexandra should advise her client that no disclosure is needed, as a 25% likelihood meets the more likely than not standard.
Let's dive into Circular 230, Section 1034, which is all about keeping us on the straight and narrow with tax return positions and disclosure requirements to dodge those pesky penalties. Now, Circular 230, Section 1034 tells us that for a tax position to fly without waving a red flag, it needs a reasonable basis. Think of reasonable basis as a pretty high bar. Definitely more solid than anything frivolous or just debatable. But here's where it gets interesting. If our position doesn't have substantial authority, we're in disclosure territory to avoid penalties. Substantial authority, it's an even higher benchmark than reasonable basis and means we're likely to win if someone decides to challenge us. All right, let's see what our options are. Option 1 wants us to believe that the reasonableness of a tax position is based on what most tax professionals think. That's not quite right. Circular 230, Section 1034 doesn't care about consensus. It's all about whether there's a reasonable basis and substantial authority. Option 2, however, is our winner. Alexandra should advise her client to disclose the position to dodge penalties. Sure, the deduction has a reasonable basis, but it's lacking in substantial authority with only a 25% chance of success. So, disclosure it is, sticking with Circular 230, Section 10.34 to keep everyone safe from IRS penalties. Option 3 says that since the deduction meets the reasonable basis standard, we're good. Easy trap to fall into. It still lacks substantial authority. So according to Circular 230, Section 1034, disclosure is needed even if the reasonable basis box is checked. Option 4 thinks a 25% likelihood is enough to avoid disclosure. Tricky. But nope, a 25% shot doesn't hit the more likely than not target of over 50%. So without disclosure, we're not meeting the standard needed to sidestep penalties. So remember, Option 2 is our guiding light here. Alexandra should indeed tell her client to disclose the position since the deduction has a reasonable basis but falls short on substantial authority.
Question. Gabrielle, an agent for Henderson Corp., entered into a contract with Reliable Industries Limited on behalf of Henderson Corporation. Gabrielle disclosed her agency relationship but failed to mention Henderson Corp's name, making it a partially disclosed principal situation. During the negotiation, Gabrielle secretly agreed with Reliable Industries Limited to receive a commission for facilitating the deal, unbeknownst to Henderson Corporation. Later, Reliable Industries Limited sued Henderson Corp for breach of contract. Which of the following statements is correct regarding the liability and fiduciary duties in this scenario? The options are: Option 1. Gabrielle is personally liable on the contract with Reliable Industries Limited, and Henderson Corp is not liable because the principal was not fully disclosed. Option 2. Gabrielle did not breach any fiduciary duties since she was acting within the scope of her authority. Option 3. Henderson Corp is liable on the contract with Reliable Industries Limited, and Gabrielle breached her duty of loyalty by accepting a secret commission. Option 4. Henderson Corp is not liable on the contract because Gabrielle breached her duty of care by not achieving the best possible terms.
Let's unravel this together. So, in agency law, a partially disclosed principal is someone whose existence is known to a third party, but their identity remains a mystery. According to the Restatement of Agency Section 6.03, both the agent and the principal can find themselves on the hook if the agent acts within their authority. Oh, and agents? They've got to stick to fiduciary duties like the duty of loyalty, which means no sneaky profits from their position without getting the principal's thumbs up. Option 1 wants us to believe that Gabrielle is personally liable for the contract with Reliable Industries Limited, and that Henderson Corp isn't liable because the principal wasn't fully disclosed. That's not quite right. In a partially disclosed situation, both can be liable if Gabrielle was operating within her authority. So, Henderson Corp has some skin in this game too. Option 2 suggests Gabrielle didn't breach any fiduciary duties since she was acting within her scope of authority. Now, this is where it gets interesting. While she might have been within her authority, taking a secret commission from Reliable Industries Limited is a big no-no, breaching her duty of loyalty to Henderson Corporation. That duty requires agents to put their principal's interests first and avoid profiting secretly. Option 3 tells us that Henderson Corp is liable on the contract with Reliable Industries Limited, and that Gabrielle breached her duty of loyalty by accepting a secret commission. That's our winner. Since Gabrielle acted within her authority, even with just a partial disclosure of the principal, Henderson Corp is still on the hook. Meanwhile, Gabrielle definitely crossed a line with that secret commission. Option 4 claims Henderson Corp isn't liable because Gabrielle breached her duty of care by not getting the best deal possible. Classic exam move. That's not quite right either. The liability here hinges on disclosure status and Gabrielle's authority, not on how sweet a deal she struck. So drumroll please. Option 3 takes the prize.
Question. In 2025, GreenTech Solutions, a calendar year small business, purchased and placed in service new machinery costing $1,500,000. The machinery is used 100% for qualified business purposes and is eligible for both Section 179 expensing and Modified Accelerated Cost Recovery System depreciation. GreenTech Solutions has sufficient taxable income to utilize the full Section 179 deduction, and the mid-quarter convention does not apply. For 2025, the maximum Section 179 deduction is $1,290,000. Reduced dollar for dollar, once qualifying property placed in service exceeds $3,220,000. What is the total first-year cost recovery deduction GreenTech Solutions may claim on the machinery? The options are: Option 1, $1,500,000; Option 2, $1,320,015; Option 3, $1,290,000; Option 4, $1,245,000.
In this question, we're on a mission to figure out the total first-year cost recovery deduction for a business asset. Sounds like fun, right? Here's the scoop. Section 179.9 lets businesses immediately expense the cost of qualifying property up to $1,290,000 in 2025. But watch out. This deduction gets reduced dollar for dollar if the total cost of qualifying property placed in service goes over $3,220,000. After taking that Section 179 deduction, any leftover basis can be depreciated using the Modified Accelerated Cost Recovery System. For property with a 7-year life, we use something called the half-year convention, which gives us a first-year depreciation rate of 14.29%. Now, this is where it gets interesting. Let's explore our options. First option says $1,500,000. That's not quite right because Section 179 caps us at $1,290,000. We can't expense the entire $1,500,000 under Section 179. The rest has to be depreciated using Modified Accelerated Cost Recovery System. Classic exam move. Option 2. $1,320,015. That's our winner. Green Tech Solutions can snag the full Section 179 deduction of $1,290,000 since they're under the phase-out threshold. The remaining basis is $210,000, $1,500,000, $1,290,000, and it needs some modified accelerated cost recovery system, love. Using that 7-year modified accelerated cost recovery system rate of 14.29%, we get a first-year depreciation of $30,015, $210,000, 14.29%. So the total first-year cost recovery deduction is $1,290,000 plus $30,015 equals $1,320,015. Option 3, $1,290,000. That's not quite right either, because it only covers the Section 179 deduction and forgets about that extra modified accelerated cost recovery system depreciation on what's left of the asset's basis. Option 4, $1,245,000. Nope, this one understates the deduction. It probably misapplies the modified accelerated cost recovery system rate or assumes there's a partial Section 179 phase-out when there isn't. Here's the thing to remember. The first-year cost recovery deduction combines Section 179 expensing with modified accelerated cost recovery system depreciation on any leftover basis. Just keep those income limitations and phase-out rules in mind.
Question. Thomas, a CPA, is preparing a tax return for his client, a small business owner. The client wants to claim a deduction for a business expense that is not widely accepted but has a reasonable basis. Thomas determines that there is at least a 20% likelihood of success if challenged by the IRS. To avoid any penalties, Thomas is considering whether to disclose this position on the tax return. According to Circular 230, Section 1034, which action should Thomas take regarding this deduction? The options are: Option 1. Do not disclose the position, as reasonable basis requires a 50% likelihood of success. Option 2. Disclose the position on the tax return to avoid penalties, as it meets the reasonable basis standard but lacks substantial authority. Option 3. Do not disclose the position, as a 20% likelihood is equivalent to substantial authority. Option 4. Disclose the position only if it is the prevailing view among tax professionals.
Regulation check. We're diving into the world of disclosure requirements under Circular 230, Section 1034, specifically for tax positions that have a reasonable basis but aren't quite substantial authority. Sounds intense, right? But don't worry, we've got this. So here's the thing. Circular 230, Section 1034 says you can claim a tax position without disclosure if there's a reasonable basis for it. What does reasonable basis mean? Think of it as a 20% chance of success if the IRS decides to scrutinize it. Now, if you don't hit the higher bar of substantial authority, usually between 40–50%, you've got to disclose to dodge those pesky penalties. Let's break down our options. Option 1 wants us to skip disclosure because it thinks reasonable basis means a 50% chance of success. That's not quite right. A 50% likelihood is more about the more likely than not standard, which is above reasonable basis. Reasonable basis is a more chill 20%. Option 2 suggests we should disclose the position on the tax return to avoid penalties since it has a reasonable basis but lacks substantial authority. That's our winner. With that 20% likelihood, you're in reasonable basis territory, but you'll need to disclose because it doesn't meet the substantial authority standard. Option 3 claims that with a 20% likelihood, you're good on substantial authority. Easy trap to fall into, but nope, 20% is just a reasonable basis. Substantial authority needs that heftier 40–50%, so this option misses the mark. Option 4 proposes disclosing only if it's what most tax pros think. Bear with me here. Disclosure isn't about popularity contests among tax professionals. It's strictly about meeting those standards of reasonable basis and substantial authority. The correct answer? Option 2, all the way. Disclose the position on the tax return to sidestep penalties because it meets the reasonable basis standard but doesn't hit that substantial authority mark. Key takeaway: to steer clear of penalties, make sure to disclose any tax positions that have a reasonable basis but fall short of substantial authority. Simple enough once you break it down, right?
Question. Josephine, a single taxpayer, had adjusted gross income of $170,000 in 2024. Her total federal income tax liability for 2024 was $20,000. In 2025, she expects her tax liability to be $18,000. To avoid underpayment penalties for 2025, what is the minimum amount Josephine must pay each quarter in estimated taxes under the Safe Harbor rules? The options are: Option 1, $4,500 per quarter based on 90% of 2025 liability. Option 2, $5,000 per quarter based on 100% of 2024 liability. Option 3, $5,500 per quarter based on 110% of 2024 liability. Option 4, $4,750 per quarter based on 95% of 2024 liability.
This one's all about understanding IRC Section 6654, which helps taxpayers dodge those pesky underpayment penalties. Bear with me on this. Under IRC Section 6654, you can sidestep penalties by paying the lesser of 90% of your current year's tax liability or 100% of last year's tax liability. But here's the twist. If your adjusted gross income from last year was over $150,000 as a single filer, you've got to aim for 110% of last year's liability. First option says you should pay $4,000 per quarter, figuring on 90% of Josephine's expected 2025 tax bill. So 90% of her 2025 liability comes out to $16,000. Divide that by 4 quarters, and you get $4,000 each time. Tricky. This doesn't meet the safe harbor for high-income folks, since Josephine's 2024 adjusted gross income was $170,000. Easy trap to fall into. Option 2 wants us to put down $5,000 per quarter based on the full 100% of Josephine's 2024 tax liability. With her 2024 liability at $20,000, that means $5,000 per quarter. Classic exam move. However, since her adjusted gross income topped $150,000, we need to think in terms of the 110% rule. So this one doesn't quite cut it either. Now this is where it gets interesting. Option 3 suggests going with $5,000 per quarter, based on 110% of her 2024 tax liability. Her liability was $20,000 back then, so bumping that up by 110% gives us $22,000. Dividing by 4 makes it $5,000 per quarter. That's our winner. It hits the mark for high-income taxpayers. Finally, Option 4 proposes $4,000 per quarter using 95% of her 2024 liability. But hang on, this percentage isn't a recognized safe harbor threshold under IRC Section 6654. That's not quite right. So there you have it. The correct answer is Option 3, $5,000 per quarter based on 110% of the 2024 liability. The big takeaway? High-income taxpayers need to aim for estimated taxes equal to either 110% of last year's liability or 90% of this year's, whichever is less, to keep those underpayment penalties at bay.
Question. Michelle, a single taxpayer, operates a consulting practice classified as a specified service trade or business. In 2025, her qualified business income is $250,000 and her taxable income before any Section 199. A deduction is $300,000. The business reports $50,000 of W-2 wages and has $100,000 of unadjusted basis immediately after acquisition of qualified property. What is Michelle's allowable Section 199A deduction for 2025? The options are: Option 1, $50,000 equal to 20% of qualified business income before applying any limitations. Option 2, $25,000 limited to 50% of W-2 wages. Option 3, $12,500 based on 25% of W-2 wages plus 2.5% of unadjusted basis immediately after acquisition. Option 4, 0 cents because her taxable income exceeds the specified service trade or business phase-out range.
This one's all about specified service trade or business and the phase-out rules for our high-income friends. So here's the deal. Under Section 199A, if you're eligible, you can snag a deduction of up to 20% of your qualified business income from a qualified trade or business. But there's a catch for SSTBs. If you're flying solo on your taxes and your income is between $182,000 and $232,000 in 2025, that deduction starts to phase out. Go over that top limit and poof, no deduction for you. Now let's break down the options. Option 1, a nice round $50,000, which is 20% of Michelle's qualified business income. Easy math says that's $50,000. But hang tight. This deduction only flies if Michelle's taxable income is under the specified service, trade, or business phase-out range. And since her taxable income is $300,000, well, that's not quite right. Option 2, how about $25,000? This one's pegged to 50% of W-2 wages. That would be $25,000. But here's the thing. This limit applies to non-SSTBs or SSTBs within that comfy phase-out range. And with Michelle's income over the range, this deduction doesn't make the cut. Option 3, the intriguing $12,000 option. It combines 25% of W-2 wages plus 2% of unadjusted basis immediately after acquisition, totaling, $12,000. Now this is where it gets interesting. It's meant for SSTBs below the phase-out threshold. Since Michelle's earnings have zipped past that range, this option doesn't work either. Option 4, a big fat $0, because her taxable income exceeds the specified service, trade, or business phase-out range. This one nails it, since Michelle's $300,000 income is above that critical phase-out zone. That's our winner. No Section 199, a deduction here. Key takeaway. For SSTBs like Michelle's situation, once you're above the phase-out range in terms of taxable income, say goodbye to that Section 199, a deduction. No matter how enticing your qualified business income, W-2 wages, or unadjusted basis immediately after acquisition might look. Classic exam move right there.
Question. John is a partner in XYZ Partnership, which operates a real estate business. At the beginning of the year, John's adjusted basis in his partnership interest was $50,000. During the year, he contributed $10,000, was allocated $15,000 of income, and received a $5,000 cash distribution. At year end, his share of partnership liabilities increased by $8,000. The partnership incurred a $70,000 loss, and John's share was $20,000. Considering the at-risk rules, what is the maximum loss John may deduct on his tax return for the current year? The options are: Option 1, 0 cents. Option 2, $15,000. Option 3, $18,000. Option 4, $20,000.
Compliance question coming your way. We're diving into the at-risk rules under IRC Section 465. These rules are all about making sure you only deduct losses up to what you're actually at risk for in an activity. For partners in a partnership, this means looking at your adjusted basis, which gets a little boost or trim from contributions, income allocations, distributions, and any changes in the partnership's liabilities. Now, let's talk about John. At the start of the year, his adjusted basis was $50,000. Over the year, he pitched in another $10,000, got $15,000 allocated as income, pocketed a $5,000 cash distribution, and saw his share of partnership liabilities jump by $8,000. The partnership had a rough patch with a $70,000 loss, and John's slice of that pie is $20,000. Our task? Figure out the max loss John can deduct under these at-risk rules. Option 1, $0. That's not quite right. John's at-risk amount actually exceeds the $20,000 loss that's been allocated to him. His year-end basis, which doubles as his at-risk amount, stands tall at $78,000. So yes, he can go ahead and deduct that full $20,000 loss. Option 2, $15,000. Another miss here. That $15,000 is just the income John got allocated. It doesn't put a cap on his deductible loss. With an at-risk amount of $78,000, he's good to fully deduct the $20,000 loss. Option 3, $18,000. Close but no cigar. This one seems to mix up calculating the ending basis after deducting the loss with what he can actually deduct. John's at-risk amount is still that trusty $78,000, more than enough to handle the whole $20 loss. Option 4, $20,000. That's our winner. John's end-of-year at-risk amount is a solid $78,000. Here's how we got there. Starting with a $50,000 basis, plus $10,000 contribution, plus $15,000 income, $5,000 distribution, plus an $8,000 bump in liabilities. Since this amount covers the entire $20K loss easily, he can deduct it all. Key takeaway time. Under IRC Section 465, you can only deduct losses up to what you're actually at risk for in your partnership interest. Contributions? They add up. Income allocations? Those too. Distributions and liability changes? Yep, they all play their part.
Question. In year 1, Quality Manufacturing purchased machinery for $150,000. In addition to the purchase price, the company paid $5,000 for shipping and $3,000 for installation, both of which must be capitalized under IRC Section 263A. Quality Manufacturing also spent $2,000 on repairs in year 1, which were properly deducted as an ordinary business expense. Over the following 5 years, the machinery was depreciated by $30,000 under IRC Section 1016. What is the adjusted basis of the machinery at the end of the 5-year period? The options are: Option 1, $128,000. Option 2, $153,000. Option 3, $125,000. Option 4, $120,000.
This question tests your understanding of how to calculate the adjusted basis for property under the Internal Revenue Code. We're focusing on some pretty crucial stuff here: capitalization and depreciation rules. Here's what you need to know. IRC Section 263A says certain costs have to be capitalized, while IRC Section 1016 deals with how we adjust the basis for depreciation. So, when a business buys an asset, the initial basis is basically the purchase price plus any extra costs needed to get that asset up and running. Think shipping and installation. Repairs, on the other hand, are usually deductible as ordinary business expenses and don't mess with the basis. Over time, depreciation will reduce that basis. Option 1, $128,000. First option says we're on the right track. It correctly calculates the adjusted basis. Here's how it breaks down. The initial basis is the purchase price plus shipping and installation, bringing us to $158,000. Those $2,000 spent on repairs, deductible, and don't touch the basis. We then subtract depreciation of $30,000 from the initial basis to land at an adjusted basis of $128,000. That's our winner. Option 2, $153,000. That's not quite right because it doesn't consider all the allowable depreciation. It seems like only $5,000 was subtracted from the initial basis. Not enough. Remember, we need to subtract the $30,000 in depreciation. Option 3, $125,000. Another miss here because it overstates how much we reduce the basis by. Looks like both depreciation and repair costs were subtracted, an easy trap to fall into. Repairs are deductible expenses and shouldn't reduce the basis. Just subtract that $30,000 in depreciation from the initial basis. Option 4, $120,000. This one's off too because it subtracts too much from the initial basis. It might be assuming repairs were capitalized before applying depreciation. Not correct. Only that $30,000 depreciation should come off the basis. So there you go. The correct answer is Option 1, $128,000. Key takeaway here? Make sure you're capitalizing all acquisition and installation costs, excluding those deductible repairs, and reducing by allowable depreciation under IRC Section 1016. Bear with me on this. It's crucial stuff for nailing these kinds of questions.
Question. Patterson Corporation appointed Samantha as its agent to negotiate and finalize a contract with a major supplier for a new product line. Samantha successfully completed the negotiations, and the contract was signed. 2 weeks later, Patterson Corporation decided to terminate Samantha's agency. However, Samantha continued to interact with the supplier as if she were still an agent of Patterson Corporation. The supplier, unaware of the termination, relied on Samantha's apparent authority and shipped additional goods. Under these circumstances, which statement is correct regarding the termination of Samantha's agency and the supplier's reliance? The options are: Option 1. The agency was automatically terminated when Samantha completed the contract negotiations. Option 2. Patterson Corporation does not need to notify the supplier because Samantha's authority ended with the contract completion. Option 3. Samantha's agency is irrevocable because it was coupled with an interest in the contract. Option 4. Patterson Corporation must notify the supplier of the termination to end Samantha's apparent authority.
This one dives into the world of agency termination and apparent authority. We're focusing on the restatement of agency to understand how an agent's apparent authority is affected when their agency is terminated. Ready? Let's break it down. Apparent authority pops up when a third party reasonably believes an agent can act for the principal thanks to what the principal has shown them. Here's the kicker. This authority sticks around until the third party gets the memo that it's over. Option 1 wants us to believe that the agency was automatically terminated when Samantha wrapped up those contract negotiations. That's not quite right. Sure, she finished negotiating, but that doesn't mean her agency relationship just vanishes. Apparent authority hangs on until the supplier, our third party in this scenario, gets notified about the termination. As per Restatement of Agency Section 3.06. Tricky, right? Option 2 suggests Patterson Corporation doesn't need to notify the supplier since Samantha's authority ended with the contract completion. That's not quite right either. Without notice, the supplier can still bank on Samantha's apparent authority. Patterson Corporation must give a heads up to squash Samantha's apparent authority and dodge further liability. Following Restatement of Agency Sections 3.06-3.12. Option 3 claims Samantha's agency is irrevocable because it was tied with an interest in the contract. Easy trap to fall into. An agency coupled with an interest means the agent must have a property interest in what they're dealing with. There's nothing hinting that Samantha had such an interest here, so no dice on it being irrevocable. Option 4 states Patterson Corporation must inform the supplier about the termination to cut off Samantha's apparent authority. That's our winner. The Restatement of Agency tells us that an agent's apparent authority lingers until the third party is clued into the termination. Since our supplier was left in the dark and relied on Samantha's apparent authority, Patterson Corporation needs to notify them to avoid getting hit with more liability. Key takeaway: in agency law, apparent authority sticks around until the third party knows about the termination. Principals need to make sure they give notice to third parties if they want to effectively put an end to an agent's apparent authority and sidestep any liability surprises.
Question. John and Mary each own 50% of XYZ Corporation. They decide to transfer property to XYZ Corporation in exchange for additional stock. John transfers property with an adjusted basis of $100,000 and a fair market value of $150,000, receiving stock worth $130,000 and $20,000 in cash. Mary transfers property with an adjusted basis of $80,000 and a fair market value of $120,000, receiving stock worth $120,000. Assuming the transfer qualifies under IRC Section 351, what is John's recognized gain and what is his basis in the new stock received? The options are: Option 1. John recognizes a gain of $50,000 and his basis in the new stock is $150,000. Option 2. John recognizes a gain of 0 cents and his basis in the new stock is $80,000. Option 3. John recognizes a gain of $20,000 and his basis in the new stock is $120,000. Option 4. John recognizes a gain of $20,000 and his basis in the new stock is $100,000.
This is all about how property transfers to a corporation in exchange for stock are treated for tax purposes. Basically, if you're handing over property and getting stock back, you generally don't recognize gain or loss as long as you control the corporation right after. But here's where it gets interesting. If you receive any boot, you have to recognize a gain up to the lesser of the gain you realized or the boot you got. Option 1 wants us to believe that John recognizes a gain of $50,000 and his basis in the new stock is $150,000. That's not quite right. Sure, John realizes a gain of $50,000, but he only recognizes a gain up to the boot received, which is $20,000. So he doesn't get to recognize that full $50,000 gain. Option 2 claims John recognizes a gain of $0 and his basis in the new stock is $80,000. Tricky. That's not quite right either. John got $20,000 in cash. So under IRC Section 351, he's got to recognize a gain equal to the lesser of his realized gain or the boot received. That means John should recognize a gain of $20,000. Not zero. Option 3 suggests John recognizes a gain of $20,000 and his basis in the new stock is $120,000. Classic exam move, almost there. While John correctly recognizes a gain of $20,000, there's an error in the basis calculation. Here's how it should go. Start with the original basis of the property transferred. Subtract the cash received, then add the gain recognized. That gives us a basis of $100,000, not $120,000. Option 4 tells us John recognizes a gain of $20,000 and his basis in the new stock is $100,000. That's our winner. He correctly recognizes a gain of $20,000, the amount of cash received. To figure out his basis in the new stock, take that original basis, subtract the cash received, add back in the recognized gain, and voila, his basis is indeed $100,000. Key takeaway time. Under IRC Section 351, when you're dealing with boot during these exchanges, recognize gain up to the boot's value and adjust your stock basis by subtracting the boot and adding back any recognized gain. All right, that wraps up our set of regulation multiple choice practice questions. Hopefully, walking through these step-by-step gave you some new strategies and a little more confidence going into test day. If you found this video helpful, make sure to like, subscribe, and hit the notification bell so you don't miss the next one. Thanks for watching.